Hello, friends. Welcome to Account Finance with Raavi, your trusted partner for smart, research-backed investment decisions. Today we are diving deep into one of India's most strategic and powerful companies, Hindustan Aeronautics Limited or HAL. This is not just any stock. This is India's backbone in the sky. Founded in 1940, that's before India even became independent, HAL has been building, repairing and upgrading fighter jets, helicopters, engines and avionics for over 84 years. Its headquarters is in Bengaluru and it operates under the Ministry of Defence. Now let me give you the big numbers. As of our analysis, HAL commands a market capitalization of approximately 3.05 lakh rupees crore. The current stock price is around 4,572 rupees. And here's what matters. This is a Navratna PSU, meaning it is one of India's most strategically important government enterprises. HAL manufactures over 15 types of aircraft and 15 plus helicopter variants. It is the only company in India that can do end-to-end design, develop, manufacture, and maintain military aircraft indigenously. So if you are a finance professional thinking about India's defense sector, HAL is the starting point. Stay with us, because in the next 9 images, we will break down every angle you need to make an informed investment call. Let's go. Let's talk money, because that's what we're here for. Looking at HAL's 10-year profit and loss, the picture that emerges is one of steady, consistent growth, with some very interesting patterns you must know as an investor. Revenue has grown from 16,758 crore rupees in FY16 to 30,981 crore rupees in FY25. That's nearly a doubling over 10 years. A top-line CAGR of approximately 7 to 8%. Solid, but not explosive. What is explosive is the net profit trajectory. From 2,004 crore rupees in FY16, HAL's net profit has surged to 8,364 crore rupees in FY25. That's a net profit CAGR of approximately 15%, far outpacing revenue growth. What this tells you? Margins are expanding. HAL is becoming more profitable per rupee of sales. Cash and bank balance stands at a whopping 38,182 crore rupees as of FY25. This company is a cash fortress. Zero meaningful debt. Borrowings are just 51 crore rupees. That's nearly negligible. But here's the red flag every investor must know. HAL's revenue is extremely Q4 heavy. If you look at the quarterly data, Q4 alone contributes 50 to 60% of full-year revenue. This is because HAL's defense orders are billed primarily at year-end. So if you see weak Q1 or Q2 numbers, don't panic. It's a structural pattern, not a business problem. Understand the seasonality. Use it to your advantage. No company operates in isolation, and HAL is a perfect example of a deeply integrated national ecosystem. At the center of everything is HAL, but supporting it and depending on it is a web of entities that makes it almost impossible to replace. On the government side, HAL's primary clients and stakeholders are the Ministry of Defence, the Indian Air Force, the Indian Navy, and the Indian Army Aviation Corps. These are not just customers. They are strategic partners with multi-decade contracts. When the government allocates 6.21 lakh rupees crore in the defense budget for FY25, a significant portion flows towards HAL. Now let's look at global partnerships. HAL has JVs and technical collaborations with some of the world's best. BAE Systems of the UK for the Hawk Advanced Jet Trainer, Rolls-Royce for Aero Engine MRO, Safran of France for avionics systems, GE Aviation of the United States for engines, and Israel's Elbit Systems for electronics and avionics. These are not casual tie-ups. These are deep technology transfer agreements that help HAL stay at the cutting edge while India builds indigenous capability. And at the base, HAL drives a massive MSME ecosystem. Over 500 domestic vendors supply components and subsystems. So HAL is not just a stock. It is a multiplier for India's manufacturing ecosystem. As a finance professional, when you invest in HAL, you're investing in this entire chain. Every great company has competition, and understanding HAL's competitive landscape is absolutely critical for your investment thesis. Let me start with global competitors. The biggest threat and opportunity for HAL comes from Lockheed Martin and Boeing of the United States. Both companies have been pitching their aircraft directly to the Indian Air Force, Lockheed with the F-21 and Boeing with the FA-18 Super Hornet. Every time India imports an aircraft from these companies, it is revenue that could have gone to HAL. Then there's Dassault Aviation of France, whose Rafale jets won a major IF contract. That was a setback for HAL's MMRC ambitions. However, and this is important, HAL is still manufacturing 26 Rafale Marine jets for the Indian Navy under a new deal. So even competition converts to collaboration here. Airbus Defence supplies the C-295 transport aircraft to India, again, initially an import. But the remarkable turn? HAL and the Tata Group have been roped in for the domestic production of the C-295 in India. Atmanirbhar Bharat at work. Now domestically, HAL doesn't have a true peer. BALE, Bharat Forge, MTR, and Data Patterns are suppliers and partners, not substitutes. Here's HAL's true moat. It is the only company in India that can design, develop, manufacture, and maintain military aircraft indigenously. No private sector company in India can replicate this in the next 10 years. That is a formidable competitive advantage. As a finance professional, you must love a company's strengths, but you must respect its risks. Let's talk about what could go wrong with HAL. Red flag number 1: customer concentration. Over 90% of HAL's revenue comes from a single customer, the Government of India, primarily through the Indian Air Force, Navy, and Army. This is a double-edged sword. Stable on one hand, but if the government faces fiscal pressure and cuts the defense capex budget, HAL's revenues can take a serious hit. Always watch the Union Budget defense allocation closely. Red flag 2: lumpiness in earnings. As I mentioned earlier, Q4 contributes 50 to 60% of annual revenue. This means if you look at Q1, Q2, or Q3 numbers in isolation, HAL looks like it's underperforming. Many retail investors panic and sell. Smart investors stay calm and buy the dip. Red flag 3: execution delays. India's LCA Tejas Mk2, the AMCA 5th generation fighter, and the HTT-40 basic trainer. All of these are critical programs facing delays. Each delay pushes revenue recognition further out. Time overruns mean cost overruns. Red flag 4: valuation. HAL trades at a PE of 30 times or more, which is high for a PSU. If broader markets correct or defense sentiment turns negative, the stock can fall sharply. Red flag 5: geopolitical supply chain. A significant portion of HAL's aircraft, particularly the Su-30 MKI fleet, uses Russian components. The Russia-Ukraine war and Western sanctions have disrupted parts supply. This is a real operational risk. Know the risks. Price them in. Then decide. Revenue visibility is everything in investing, and HAL has one of the strongest order books among all listed Indian companies. Let's break down who exactly is paying HAL and what the scale looks like. The Indian Air Force is HAL's largest client, generating the majority of revenues. The IF currently operates 272 Su-30 MKI jets, all manufactured by HAL. Each of these jets requires periodic overhaul, spare parts, and upgrades, generating steady annuity-like revenues for decades to come. More importantly, the IF has signed a contract for 83 Tejas Mk1, a light combat aircraft worth approximately 48,000 crore rupees. Deliveries are beginning, and this contract alone provides revenue visibility for the next 7 to 10 years. The Indian Army Aviation Corps is a growing client. HAL's Dhruv Advanced Light Helicopter Fleet, the Rudra armed variant, and the light utility helicopter are all in active service with ongoing MRO contracts. The Indian Navy is the newest and most exciting growth area. HAL is set to deliver 26 Rafale Marine aircraft for the Navy's aircraft carrier. a contract that expands the Navy-HAL relationship significantly. The naval LCA variant is also under development. On the export side, while small today, HAL has supplied Dhruv helicopters and Do-228 aircraft to Mauritius, Sri Lanka, Nepal, Ecuador, and Namibia. The government's push for defense exports could make this a meaningful revenue stream by 2030. And then there's the MRO business. HAL maintains over 800 aircraft across all three services. This is recurring, predictable, high-margin work. True annuity income. HAL's confirmed order book exceeds 94,000 crore rupees, with a pipeline of over 1.5 lakh rupees crore. For a company doing 31,000 crore rupees in annual revenue, that's nearly 5 years of revenue already locked in. Now let's talk about what excites me most as an analyst, the growth drivers that will determine HAL's stock price over the next 10 years. Growth Engine 1, Tejas Mk1A. This is HAL's biggest near-term revenue driver. 83 aircraft, approximately 580 crore rupees per unit, totaling 48,000 crore rupees. Deliveries have begun and will continue through to 2031. Additionally, the IAF has expressed interest in ordering a further 97 Tejas Mk1A aircraft. If that order materializes, we are talking about an additional 60,000 crore rupees. Combined, that's over 1 lakh rupees crore from Tejas alone. Growth Engine 2, AMCA, India's fifth-generation fighter. This is the crown jewel of India's aerospace ambitions. A stealth, twin-engine fighter jet designed and built in India. HAL is the prime contractor. The order potential over a 20-year life cycle is 1.5 rupees to 2 lakh crore. The program is in design phase. First flight expected around 2028 to 2030. This is the long-term mega driver. Growth Engine 3, Light Utility Helicopter tender for 156 units worth over 21,000 crore rupees. HAL's LUH has already been selected. This is the largest helicopter procurement in Indian history. Growth Engine 4, Defense Exports. India's government has set a target of $5 billion in defense exports by 2025 and $10 billion by 2030. HAL is the flagship. Countries across South Asia, Africa, and Southeast Asia are interested in Dhruv helicopters and the Do-228 aircraft. Growth Engine 5, Engines and MRO. HAL is developing the HTFE-25 turbofan engine for its HTT-40 trainer jet. The Kaveri engine program for the Tejas is also being revived. Engine manufacturing is the highest margin segment in aerospace, and HAL entering this space is a potential game changer. Bottom line, HAL management has guided for revenue targets approaching 1 lakh rupees crore by FY34. I believe this is achievable, but execution is key. Let's talk about the balance sheet, because this is where HAL truly surprises you. First, the cash position. As of FY25, HAL holds 38,182 crore rupees in cash and bank balances. Let that sink in. 38,000 crore rupees in cash. That's more than 1 full year of revenues sitting in the bank. This makes HAL one of the most liquid PSUs in India. Second, the debt position. HAL's total borrowings as of FY25 are just 51 crore rupees. Essentially zero. For a company with a balance sheet of over 1 lakh rupees crore, the debt-to-equity ratio is negligible at 0.001x. This is a company that has funded its growth entirely through internal accruals. No dilution, no leverage risk. Third, operating cash flow. HAL generated 13,643 crore rupees from operations in FY25, up from 8,222 crore rupees in FY24. The cash generation engine is accelerating. Fourth, returns. Return on equity is approximately 24%, and return on capital employed is around 26%. These are exceptional numbers for a PSU in a capital-intensive sector. It means HAL is highly efficient in converting its capital base into profits. Fifth, dividends. HAL paid out 2,675 crore rupees in dividends in FY25, maintaining a payout ratio of approximately 32%. The government, which holds 71.6% stake, is the biggest beneficiary. This creates an inherent political motivation to keep dividends high. Summary: HAL's balance sheet is a fortress. Pristine, cash-rich, zero debt, high returns. For a value-oriented finance professional, this financial quality is rare in the listed universe. Let me take you on a 10-year journey, because understanding where HAL has been is crucial to understanding where it's going. In FY16, HAL stock was trading around 566 rupee per share. Fast forward to FY25, and the stock touched 4,572 rupees. That is an 8 times return in approximately 10 years. This is the power of investing in quality, strategic PSUs. But the journey was never a straight line. In FY20, the COVID-19 pandemic disrupted global supply chains and HAL stock fell sharply to around 260 rupees. Raw material imports, particularly from Russia and Europe, faced delays. Investors who understood the fundamentals and bought the dip were richly rewarded. In FY21 and FY22, the narrative shifted dramatically. The Government of India launched the Atmanirbhar Bharat initiative, dramatically increasing the positive indigenization list for defense, mandating that specific weapons and systems could only be procured domestically. HAL was the primary beneficiary. FY23 was the year HAL demonstrated execution capability. Tejas deliveries began, the first aircraft formally inducted into the IF's number 18 squadron. Net profit crossed 5,800 crore rupees. In FY24 and FY25, HAL hit record after record. Net profit of 7,621 crore rupees and then 8,364 crore rupees. Cash pile swelling to 38,000 crore rupees. Order book exceeding 94,000 crore rupees. The story of HAL's last decade is a story of patient accumulation, strategic vision, and India's defense self-reliance coming to life in stock market returns. The question now, can the next decade be even better? Alright friends, we've done the full X-ray analysis. Revenue trends, balance sheet, competition, ecosystem, risks, and growth drivers. Now comes the question you've been waiting for. Should you invest in HAL? Let me give you the bull case first. HAL is the only company in India with end-to-end indigenous military aircraft capability. No private company comes close. And with the government's Atmanirbhar push, this monopoly is getting stronger, not weaker. The 94,000 crore rupees confirmed order book gives you 3+ years of revenue visibility. The 38,000 crore rupees cash position is extraordinary. Zero debt, high ROEs, dividend income, and a government as your 71% anchor shareholder, which means the company will never be mismanaged into oblivion. The secular tailwind. India's defense budget is growing at 6 to 8% annually. India is moving from being the world's largest defense importer to a significant exporter. HAL sits right at the center of this transformation. AMCA, Tejas, LUH, Rafale Marine, multiple programs with multi-decade revenue streams. Now the bear case, or rather, the watch list. Single customer concentration is real. Execution delays are real. Valuation at 30 times PE is not cheap. Supply chain vulnerabilities from Russia are real. And while private sector entry won't displace HAL in the near term, over 10 to 15 years, it will create competitive pressure. My verdict: HAL is a long-term strategic hold for patient investors with a 5 to 10-year horizon. For those who don't yet own it, use market corrections, weak quarterly results, or broader market dips to accumulate at better valuations. APE below 25x would represent an attractive entry for long-term investors. This is not a stock for short-term traders. This is a stock for people who believe in India's defense story. And based on everything I've shown you today, that story is only just beginning. Thank you so much for watching Account Finance with Raavi. If this analysis added value to you, please like this video, share it with fellow investors, and subscribe so you never miss our deep dives. Until next time, stay analytical, stay disciplined, and invest with conviction. Jai Hind.
Subscribe to Account Finance with Raavi for finance and accounting insights.